As a lender, one of the first questions that I get from anybody is, what can I afford? And that makes sense. It's the first thing you have to actually decide when you're shopping for a new house. On the surface, this may seem like a relatively easy question to answer. I just gotta look at how much money you make, right? Well, the answer can be a little more variable than that. Affordability can be a pretty subjective matter, and people's tolerance for their housing payment can differ a lot from person to person. There will be financial obligations in your life that a lender won't use to determine how much house you can afford. At a certain point, you as the buyer are ultimately responsible for determining how much of a monthly payment you want, or else you risk overbuying for your comfort level. Determining what you qualify for can be different from what you're actually comfortable with paying. Lenders and financial institutions, when determining your qualification number, will look at two things: your income and your debts, and they'll compare those two. And debts means specifically debts. So student loans, credit cards, car payments, even your future projected monthly payment on the house. This doesn't include things like your power bill, your phone bill, your Netflix subscription, or how much money you like to spend per month on coffee. Comparing these two numbers, your debts and your income, will give us a number called a debt-to-income ratio. Now, that ratio will tell us roughly how much of a monthly payment that you qualify for. The monthly payment that you qualify for will largely determine what the maximum sales price for the house you're shopping for will be. Now, getting down to some practical stuff, financial websites and other professional gurus typically will suggest that you stick under 25% of your gross monthly income for your housing payment. However, I found this number to be relatively challenging for most people, as if you make $60,000 a year, this would only allocate $1,100 per month towards your housing payment. The 25% rule is not enforced, and our actual guidelines are much higher than that. I like to see clients come in at 40% or less, but exceptions can be made, and I've seen it all the way up to 55%. So, if you made $60,000 a year and you had no other debts, you could qualify for a housing payment of around $2,600 a month. Now, whether or not that is something that you would be comfortable with is a more personal question, but that would be the maximum amount that our guidelines would allow in certain cases. So, how much house can you buy at different monthly payment amounts? Without getting into the weeds on what a mortgage payment consists of, and I'll be making a video on that some other time, so subscribe if you want to get notified when that drops, we can look at some rough numbers to get an idea of how much things cost. At $1,000 a month, you'd be looking at a loan of about $110,000. And there's a bunch of ways to get to that $110,000 loan amount. For example, putting $100,000 down on a $210,000 home would leave you with a loan amount of $110,000. There's a million ways to do it. At a monthly payment of $1,500, the loan amount would have to be $200,000. At $2,000 per month, the loan amount could go up to roughly $280,000. $2,500 a month would be a $350,000 loan. And if you were comfortable increasing your monthly payment up to $3,000 a month, the loan amount could increase up to $430,000. Of course, these are just rough examples, and in no way are these actual loan estimates for your personal situation. If you want more detailed information, reach out to me directly. But a decent rule of thumb, using today's market numbers, is every $500 would be approximately worth $80,000 worth of loan. So I hope you learned something. If you did, drop a like. Subscribe if you want to see more regularly. I'll hopefully be posting these on a more regular basis. I'll see you guys next time.